Welcome back. Warm welcome from Munich. This is episode 13 already of our Digital Traders Summit series. And I have to say, when we started that in March, the idea was really to stay in contact for a very few weeks while we are in home office, to stay connected with our clients, our users, and all our friends out there. Now it's episode 13. I'm really thrilled to see again that we have more than 250 participants in line. That's great. Thank you very much for participating, continuing to participate in this way. Today we are back to PPAs, a very important topic. We had already one session where we were more looking on the different risks involved with PPAs and how the market is evolving and its potential. Today, we'll go a little deeper into the connection of PPAs and the wholesale energy market. And I'm very happy to have an excellent guest on this topic with us. He needs no introduction as his company as well. So Dr. Tobias Paulun, he's the Chief Strategy Officer of EEX, and he can give us more insight on how hedging on the wholesale markets together with EEX can work for PPA players, and how basically fundamentally that PPA business on one side and wholesale trading on the other belong together, and there's lots of synergy potential if we get these closer together, actually, as it happens today. So I'm very happy to have you with us. Mr. Paulun, thanks for joining us, and I directly hand over to you. Thank you.
Thank you, Jens, and very warm welcome to everyone in the audience here. It's great to have such a huge interest in our topic today. Thank you also to Enmacc in general for providing the platform for such a discussion. I'm looking forward to give you some overview, as Jens said, about what EEX is doing in the area of long-term hedging with a special focus on power purchase agreements. I'm looking forward to any questions and also feedback that you might have in this regard. So we've prepared a few slides today to show a bit better on what we're actually doing and how we see the PPA segment in the market to be of value, in particular for renewable energy producers. Let's directly jump into slide number 1, which is meant to give you an overview about EEX members and their respective activities in the area of power purchase agreements. Before we go through these different areas here, I'd like to outline that the exchange and in particular EEX Group have been active in the area of renewable energies since the very beginning, and we actually did also some trial and error initiatives in order to find the best possible ways of providing tools for hedging of market price related risk related to renewable energies, both on the spot and on the derivatives markets. Over more than a decade now, we've found several product initiatives that really add value, and we are convinced that the area of long-term hedging, and with long-term I mean everything dating beyond the 6 calendar years that the exchange market is currently offering, any product in that area can add value to address the bilateral agreements that are currently being agreed in the market. So what are our members currently doing in the different market segments? By members, I actually mean a network of more than 600 companies trading directly on the exchange, and beyond them, more than 2,000 traders being active on the market on a regular basis. So really a broad network from various industry segments, as we will see in the second. Some of them actually sell power off exchange. We can stick with the first slide here for a few seconds just to make sure we cover it completely. Some of these members of the exchange sell power via long-term power purchase agreements and then bring this onto the exchange market. So going through the slide from top left to lower right here, starting with the producers and investors who might not have an interest to act on the energy market themselves. they just sell power via dedicated long-term agreements to those players who are more experienced in managing energy portfolios. And this is where the exchange members come in. They buy this power via long-term PPAs, and some of them actually also build renewable energy assets on themselves. Now, the first value that the exchange client network here adds is actually on the short end of the curve, by providing portfolio management services and also balancing services on spot and short-term future market. So this is already one area of synergies between the off-exchange, more bilateral-driven OTC market and the standardized exchange venue, providing the balancing services and portfolio management services on the short end of the curve. On the long end, and this is what I'm going to focus on now in a minute, it's more about the financing of investments and managing the really long-term market price risk. Here, another kind of players comes in, financial institutions and banks providing financing, and many of them actually have as a prerequisite power purchase agreements being in place to take out some risk related to the investments. Here again, EEX members can contribute to the liquidity in the market by providing or by offering the taking over of price risk 6 and more years out. So moving to the next slide, you already had a glance at this. We just mentioned a couple of industry segments who you can find within the client network of EEX, and actually all of these segments have grown over time. Utilities are certainly one of the backbones of the market still today. It's fair to say that almost half of the trading volumes on the derivatives markets is somehow related to the activity of utilities. So these physical players are an important backbone of the market, as they are usually always there, not only driven by volatility trading opportunities, but by a pure physical hedging need. We've also seen more and more players from the heavy industry, like oil companies or even off-takers of renewable energies, to move to the exchange market themselves. More and more of them now becoming part of the client network that's directly connected to the market. Renewable energy producers, again, also some of them have chosen to market their energy directly, but it's also fair to say that some others still make use of intermediaries, which is the fourth element here. Banks providing access to the market for renewables, but also market players offering hedging services as a service to third parties. So overall, a very diverse client network, and that is one of the success factors that has contributed to the growth of liquidity since the beginning of the market, actually. Moving on to the next slide. Now I'd like to go a bit deeper into the actual application of products that are offered on the exchange for hedging renewable energy price risk. The charts on this slide here are certainly a bit simplified, but you can see a typical wind profile and a solar profile on the left-hand side of this slide. Now, at first glance, it doesn't seem obvious how such a profile, which is typical for a renewable energy asset, how such profile can be hedged with tools offered by the exchange. Still, the most commonly used hedging instrument is still the base load profile, meaning a constant power delivery 24 hours a day, 365 days a year. Now, why is that? Base load profiles are still those products on the exchange which show the highest liquidity and the most diverse network of traders actively using this tool. So they are the most competitive instrument, priced at very low bid-ask spreads, and from that alone, a very attractive tool for hedging price risk. In addition to these, EEX offers a couple of tailor-made products like blocks covering only certain hours, a day, or even short-term contracts covering only several days per month and year, which can further specify a profile to bring it closer to the actual production of a renewable energy asset. So to use the base futures to manage the risk of a wind or a solar profile, a hedging strategy needs to be developed. You need to be clear about what is the base risk that I want to get rid of by trading on an exchange, and which residual risk do I accept as part of my overall portfolio. Now, it's important to note that price risk alone can account for up to 70% of the total risk related to a PPA. So it's a major factor for the risk if you decide to keep a PPA unhedged completely in your books. Getting rid of that, in turn, provides significant opportunities to reduce the overall costs of a portfolio and, in the end, to get a more secured and stable rate of return from a renewable investment. So bringing the two together does not only have some synergies for players, but even lowers entry barriers to the market. And I would phrase it like, by combining power purchase agreements with standard baseload products on the exchange, we can really bring the market to a next level, as we will also see on the next couple of slides. Maybe we move on to the next slide. This is just an example for one exemplary long-term hedge that really took place here, this time in the Spanish power market, which is in terms of PPAs, the most actively traded so far. It's a trade data from March this year, covering several years into the future, 2021 to 2024. In this particular case, each individual year was priced at the same level at 39.5 euros per megawatt hours. That's just an example, and it depends on the individual agreement in the respective PPA. In fact, you could also have different trade prices per individual year. In the example, 5 lots were traded, and now, as you might be aware of, when trading on an exchange, you need to deposit initial margin in order to cover any potential fluctuations in market prices and value. This is a real-life example here, and the margin per contract varies between 10,000 and 20,000 euro per calendar year, roughly. So as here 5 lots were traded, we are talking about a total initial margin of something like 300,000 euro to secure a notional value of close to 7 million. So that's quite an efficient way to secure the risk. It's just 4.4 roughly % of the notional value that needs to be deposited in terms of initial margin. And by doing so, you can be fully sure that any market price and any default risks are fully taken over by the clearing house. So since March, further trades have been registered on the exchange. Actually, we count 33 really long-term hedges in Spanish power alone so far, with a total volume of close to 16 terawatt hours. Tendency clearly growing. We can move on to the next slide, and I've seen that there are a couple of questions already, and happy to take them up after the presentation, unless there is something that we should clarify immediately. Then Jens, just let me know.
No, I think we take it all together at the end and have a focused discussion. That's usually better. Thanks.
Happy to, thanks. So I'd like to focus a bit more on the margins that I just presented and how they are calculated, because there are two contradictory effects when determining variation margins. What you can see in this slide are the prices for 2 different calendar years along the curve, Cal +2 and Cal +6 respectively, shown over a period of 1 year from September 2019 to 2020. What you can see here is that the volatility in the shorter term maturities are usually higher than on the long end of the curve, which is just because liquidity is also higher and prices are influenced slightly more by short-term new information. On the other hand, if unforeseen events take place, like in this example around March this year, it was the start of the COVID shock, these events tend to influence longer maturities more than short-term maturities, for the same reason, having less liquidity in the market and more uncertainty about what the actual price might be 6 years out. So when determining variation margins for the different contracts, we do not only need to account for day-to-day volatility, but also for possible price fluctuations that may arise as part of such a market shock. Nevertheless, we tend to see lower margins at the long end of the curve compared to shorter contracts, as you've seen on the previous slide. Moving on in the presentation, and I'm also conscious of time to make sure we can discuss thoroughly any questions that might come up. We clearly see an increasing demand for power purchase agreements and the respective hedging tools linked to that. It's not only renewables and investments that are driving demand, it's also the buy side of the market who wants to secure green energy for several years in advance. Now, to make sure that these two can meet and do not need to take care of any unreasonable market price risk, we see as a core task of the exchange. On the lower part of this slide here, you can see that currently the exchange markets covering everything out to Cal +6, so the current calendar year and the next 6 to come. This has worked very well in the market environment so far, where typically the hedging horizon was only 3 years out. However, this changes fundamentally with this demand for renewable investments and the interest of the buy side to secure such contracts in the long run. And typically the hedging horizons now shifts to 10 years out or even beyond. Even 15 years and 20 years are not uncommon, but clearly managing risk for the next decade would already be a major achievement. So in that regard, we are currently working on extending the current EX futures coverage from 6 to 10 years. We are working particularly on the risk model here for that and getting that approved. And once that is done, we're happy to announce the respective start date to the market. The examples that we have shown so far all took place in the Cal +6 range, but we expect significant additional volumes to come once the range of standard contracts has been extended. All right, let's make sure we cover the rest of the presentation. So I manage the risk model that is required for these contracts. We will rely on several price assessments for the contracts further out the curve, and we will calibrate internal risk models accordingly as we receive new information from the market. As a standard process, we intend to run a market survey here among trading members for providing fair values of the curve for all contracts that are offered. Just in case not enough members can share their price views, we use the model-based approach to extrapolate information that is available so far onto further contracts. This methodology will be implemented at the exchange market as an addition to the already existing daily settlement methodology, which is also approved and supervised by the respective regulators. So all the offerings here related to long-term hedging will be under the full supervision of regulators, hence fully governed by the usual licenses of EEX. Actually, we also look forward to working together with Enmacc, just mentioning this example on their tool for getting market price information. This clearly also adds value to the market, and I would see the two as really being complementary with the common goal of providing a better link between off-exchange PPAs and standard products. Right, so let's close that off with the next slide, with which I would then also want to lead over to the discussion. Just as a summary, power purchase agreements are clearly an enabler of renewable energy investments. In fact, many banks require them as a prerequisite for providing financing for new projects. However, they also entail a significant amount of market risk, covering default risk, but also risks related to market price movements. The good thing is that this is not a new thing. The market is very experienced in managing these kind of risks. We just have to link it to the PPA market and provide access for these players to standardized and risk management procedures. Major players from all different kinds of the industry, as I've shown on the beginning, utilities, investors directly, but also direct marketers and banks. Many of them are directly active on the exchange market themselves, but several also do use the services of intermediaries. We are currently consulting with all of them to understand their need for products and market price information even better. And then, as I said, looking forward to announce a start date for these long-term hedges in the respective power markets soon. However, today I'm looking forward to the discussion. It's not only about the X market here. In fact, we see ourselves also as an enabler of the overall power market. And in the long-term area of the market, clearly exchange trading and OTC are very much complementary. So thanks in advance for any questions and your feedback, and I'll hand over back to Jens to moderate this.
Yeah, thank you, Tobias. Excellent overview of the service, and I think it's personally, I think it's a great addition and will help develop these long-term markets. You said you were very much consulting as well with the market participants about building this hedging. I think that's important. It's a joint effort. Whenever we talk to participants, there are basically two groups. One who are really supporting these developments, others still believe in having superior information and not being interested, disclosing that always with the whole market, and coming sometimes more from a margin perspective, what they can still maintain in this business. What is your experience with that?
I mean, that's absolutely true. Of course, some players do already have more experience in that market segment than others and would not want to give away this advantage. However, I clearly say that having an efficient tool to manage default risk and long-term market prices is in the interest of all of these players. And here again, I think the two can very well go together. I mean, an obvious example is that some of the more experienced ones provide services to smaller ones and newcomers and manage smaller investments as part of a larger portfolio. Again, that would be a win-win situation. But even neglecting this, as I've shown on one of the slides, 70% of the risk in a PPA are related to market price risk, and not managing these adequately can quickly overcompensate in a negative way any margin advantages that you might have. So here I think the interests of all of the players are very much aligned. And this is also the feedback that we got through these consultations, from larger ones to smaller ones, that such tools are urgently needed.
Absolutely. And you pointed rightfully out that it takes as well the diversity of different players in the market, taking different roles. To be very specific here, in the US market, you have quite some active banks as well, being hedging these long-term contracts. Could be a Citi or it could be a Goldman Sachs who are active in this market. How do you see this in Europe? Are banks active, or are they interested in increasing their engagement even?
Yes and no. We have seen, unfortunately, some banks restricting their portfolio recently and focusing on other areas of their business. However, some are also clearly still committed to provide this financing, even though they might not be active in commodity trading themselves. But still, they are available for financing renewables investments. That is clearly a growth area. So even better if the utilities and other players can add from the physical side here, taking over the portfolio management that the bank does not want to be active in, still enabling the bank to provide the financial service.
Excellent. Yeah, I'd like to ask the audience as well to send more questions. We still have time and interest in discussing more. You said rightfully, I simply continue now. One question here was around OTC trading versus exchange. I think it's no surprise that we have this talk together. I think there is a close relationship working together. Many of the trades so far are OTC negotiated, let's say, and then registered for your clearing service. Is that right still? Or yeah.
Absolutely, yes. Directly registered, yes. Basically, the new products that we intend to offer will be available from day one for all of the existing members through the existing clearing member channels. There's no need for new registration or anything like that.
No, I was more talking about the trade registration. So many of them are still OTC negotiated in a way, no? Is that correct?
Oh, yes, yeah. Absolutely. Oh, yeah. I mean, the distribution channels are also the same. Yeah. Long-term contracts can be traded in the order book, but the trades that we have seen so far actually came through the channel of trade registration. And that's a more common way. If there's a bilateral PPA in place already, then typically the standard contracts are trade registered for clearing thereafter.
Yeah. So again, there's one question regarding the timeline. When can we expect the hedging? Up to 10 years? You said beginning of next year? Was that?
Yeah, unfortunately, I can't announce your live date yet, but I would say stay tuned. It will be soon. Talking under the control of the regulators as well here, as the risk model really needs to be thoroughly designed, and we're in the final phase of getting that done. So I expect to have more information on that soon, clearly within this year.
All right. Then we have two questions. I think they go in the same direction a little bit. This is the base load price or hedging now. It's the merchant risk. What about the volatility? Are there ideas how this volatility could be hedged as well? Specific solar products or wind products? I think you made some experience with that as well in the past, no? So here's a question specifically about better solutions for solar producers. Is there something to be imagined?
Yeah, as I said earlier, we did also some trial and error over the last almost 10 years. And we did start products specifically designed also for renewables, like short-term options and also products with specific load profile. But what we found in the end was that it always turned out to have the highest value if we bring all kinds of players together in standard products. So whenever we try to make it more specific, actually the network effect became much lower. And so this is also a reason why I think the approach via standard contracts, base load calendar years, is a really promising one, because that's a product that everyone can trade.
Absolutely.
On volatility, can I go one further comment on volatility? I actually expect this to be more of interest going forward. We see the options market growing steadily over the last years, and once this has more liquidity, this is actually then also a prerequisite to provide more tools for volatility hedging, as it's already common in financial markets. So definitely, this is something we will look at going forward.
All right, very good. There's two questions regarding specific participants in the market as well. So first question, are there really renewable energy developers trading directly on the exchange already? You see this as a trend or coming?
Not so many, to be honest, so far, but we have some projects where the developers are working closely together with an energy supplier, and that is already a member of the exchange. I mean, if a developer really comes in from a pure investment perspective, he has usually no interest to do the portfolio management. But we've also seen large utilities going into the developer role themselves, and in that case, they usually manage the portfolio directly on the market.
Yeah, there we've seen as well some participants building now teams up for the short-term market, but as well for long-term. I think that is a development, but it depends on the scale of the business.
Absolutely.
To be feasible. Absolutely. And then there's one question I directly translated, or how do traditional power traders help the PPA market grow? That's a...
Yeah, I mean, they have been involved in these trades that we have seen so far. So apparently they are there, and they are one of the first among the first companies to be contacted by renewable energy developers who want to find a counterpart who takes off their energy portfolio. So they are there, they offer their liquidity and also their financial capabilities, of course, but then they sit with the energy and want to market it somewhere. So they provide an initial liquidity here, just as they did when the power trading started 20 years ago or a bit longer. They were there doing the first steps. Until then, other players came in and built liquidity to the next level. Yeah.
Maybe I can add on that. I mean, you mentioned quickly our Enmacc Echo product, where we are trying to bring liquidity into these markets. And it was surprising to me that still very often it's the renewables guys or departments, let's say, taking over, while the traditional power traders, they are very much focused on the next 5 years. And interest is not always there yet to engage really in trading activities. So we try to convince there as well. And I think there is ongoing discussions in many of these companies how the PPA business can be closer to the trading operations. And I think it's very interesting to watch that, because at the end we want to have a real trading happening, not just individual hedges. I mean, that takes on the trading desk. Yeah.
I would see it going this hand in hand with the development of the products. The more standardized they are, the more closer this activity I would expect to move to the traders, but to be seen.
Yeah. At the moment, it's really a very close collaboration between the risk managers, the PPA developers, and the traders. And I think the best companies we have seen there have a very close collaboration and have a clear vision how they want to do it together. But it's handled very differently. Yeah. Good. I'm asking again the audience to submit more questions. So we still have time and absolutely interest to hear what you think. Anything more coming up? Not at the moment. Maybe you have a perspective on the PPA market in Germany. I mean, we talked about Spain. I think you have been even active in Poland, if I heard it right.
Yeah,
Germany.
Poland.
Yeah. Well, how do you see this?
Poland, Italy as well. Yeah, I mean, in Germany, we're currently having a huge debate about the future of the renewable support schemes, and we are actually a bit concerned about that one, because there is definitely a tendency in the debate to move market price risk back to the state and socialize them. Which would really diminish liquidity and also the competitiveness of the market. It's a bit unfortunate that this debate comes at a time where the market-based solutions are now actually being developed and will be available soon. But definitely in the future of the PPA market in Germany and the link to the standardized product will be heavily impacted by the outcome of this debate. So it's even more important to show that these examples are really working, and what I've shown you are real life examples, not theoretical trades, but something that really occurred. We only took the Spanish example, but there are similar ones also covering 6 years out for Germany. Still, there's currently still some reluctance among the players to fully focus on this opportunity, as everyone is also awaiting the political decisions on how the support schemes look forward.
Yeah. Absolutely. I mean, sometimes you have the feeling that there's lack of trust in these market-based mechanisms to bring value to these markets. Sometimes we have the same discussion, I think, on emissions trading in Germany. So I think it's very good to prove that it works, and even if it's still in other regions happening or not on a huge level yet, but I think it's just the beginning. Yes, exactly, to develop it.
Absolutely, and if there's one lesson that we can draw out of the development of the power market as it works today, it's clearly that those who contributed at the very beginning and were among the first movers to get clearly had a long-term advantage. So also linking back to your first question here, being among the first movers, I think you can even strengthen the competitive advantage that you already have by making your own trading activity even more efficient and the overall market bigger.
Yes.
For me, that is a more promising view than trying to secure a margin advantage in a short-term perspective.
Yeah, I absolutely like the idea. I think there's still huge potential for all of us together to grow the markets as an ecosystem in a way. It's not so much about going for market share here in any way, not for players, not for venues, if you wish. So I think there's a huge potential still in front of us. Good. We're not getting any more questions right now, or no? Sorry, I was wrong. There were no more questions coming in, so I picked them up. Excuse me. How can EEX help smaller players? I think that's a good question. I'm summing it up a little bit. We've seen that the big ones, the multinationals, are very active now and positioning themselves as well with lots of marketing effort in this field around PPAs. What about smaller players? We're not talking small companies here. We're talking the mid-sized, very much German players as well. How can they benefit from these trends, or what opportunities do arise for them?
Yeah, I mean, they have the same opportunities as the others. The exchange is fully non-discriminatory here and open to everyone. Actually, we see already today that the majority of big companies who trade actively on our market do this indirectly through intermediaries, and that service is also available for everyone, smaller players. Nevertheless, even if it's indirect members, we're still happy to support them. And if there is anything that we can do to facilitate an admission to the exchange or to provide even training and education, we are always available to support all new players here, of course.
Could it be that for mid-sized players which don't have these huge portfolios, the hedging on a wholesale market could become even more important than for the big ones? I think big players have huge portfolio effects as well in managing the risk, no?
Yeah, there is definitely an element of scale in it. Yeah, in a larger portfolio, you can manage some risk more efficiently, and the risk appetite might also differ, and depending on your financial capability, might take more risk onto your book. But it fully depends on your individual hedging strategy. And your expectations on rate of return. But I mean, to be honest, in the market situation we're now in and the next months ahead of us, I would expect that the focus on potential default risks will even increase. And yeah, it's good to know that with the clearing solutions, there is a tool available which fully covers any potential defaults in the market.
Yeah. And we have several questions, actually, I'm very happy about that, who ask how can this be applied or when is it offered in other countries as well? So three questions here coming from participants from Eastern Europe, which is great. So what about the Hungarian market, the Romanian market? We have here questions, and as well questions from Czech participants. What are the plans is that possible to see this in these markets as well?
Yeah, in the mid to long run, of course, our target picture is clearly that we have the full range of calendar years offered for all the markets that we're active in. The good thing is that the risk management methodology only needs to be developed once. Once we have that in place and in operation in our clearinghouse, it's independent to which contract we apply this. Nevertheless, we do need a sufficient number of players contributing also to the price assessments. I mean, if the long end of the curve is really completely intransparent and nobody really has a view on what fair market value might be, then it's really difficult to offer such a contract. But if there is a sufficient audience and client network wanting to kick this off, we can always list the contracts then on relatively short notice.
Absolutely, very good. One more specific question. You explained on this example of the Spanish deal that the initial margin was a little bit more than 4% only for the next 6 years. How's that going to look like for the additional 4 if they're 10 years longer?
Yeah, that is a typical range. Actually, I would not expect it to be significantly different if we extend the curve, so it should be in the same order of magnitude. The longer out we cover the curve, the more prominent the potential default risks become. These are the contradictory effects that I mentioned earlier. On the short end of the curve, variation margin is very much driven by the daily volatility. On the longer end, the potential default risks and the risk of not finding someone who would support in case of liquidation of a portfolio, that risk becomes more pronounced, but still it would be in the same order of magnitude as seen in this example.
Right, very good. And then, as in all of our webinars, we had one question around Brexit. How is that influencing your decisions on how you look at the market? Is it tied to this topic? Is there an influence?
It's not tied to this topic. Now we have actually all our licenses in place, so the derivatives market here will not be impacted. We read today the news here that probably the UK would leave the market coupling on the spot market side, but on derivatives we do not see any such impact. So everything that I presented today is equally true for a UK market post Brexit. Okay, so these kind of 10-year contracts could even, be offered as well in UK and absolutely. Summing up, there's more to come, I hear. This is getting launched here in the first markets. Excellent, very good. No, I have to say again, thank you everyone for participating with the questions. Thank you very much, Tobias, for this excellent presentation and very insightful discussion. Very happy about that. Thanks a lot for joining us today. Very few closing remarks. We are back live in 2 weeks with 2 colleagues from McKinsey, who will talk as well about new trading opportunities in the market and what advanced analytics can do for traders in this regard. Looking really forward to that discussion as well, going more a little bit in the technical side of the business. Thank you very much. Hope to see you all again back. And thanks again, Tobias Paulun. Thank you. Yes, thanks.